But Bonawyn, do you feel better?
I think I feel better, but again, that's a relative term. I mean, there were some pretty dark days there for a lot of us. I think as we watched, what was it, 6, 7, 8 weeks of continual downward pressure. And so when I look at a market like this, it's the extremes that concern me. So we've had the best week since 2020, after having the worst streak in a decade, after having the greatest bull market in the past decade, after having oil price at the highest level and inflation at the highest level in several decades. It's all of those conflicting messages that make it very hard for me to take one data point and try to extrapolate that out to a trend. And if there's one thing that I think the Fed has told us, even if it's going to be at the detriment of moving too slow, they will be methodical and data dependent. They were slow, methodical, data dependent when it came to seeing inflation and taking moves to combat that. I expect that they will be very deliberate and data dependent when it comes to changing course. And so one PCE reading, which is marginally lower, to me is not enough for me to get excited about the Fed pivoting from what they're going to do, for QT to stop or abate, or for rates to not continue to be ratcheted up by 50 basis points. So, yeah, I think it's a pause. I think it's natural. Technically, there were instances where we were oversold, but I have a lot of reason to think that this is more of a head fake.
But Bonawyn, do you feel better?
I think I feel better, but again, that's not push the Fed to move in any other direction than what they've told us they intend to do.
On this edition,
and I think that's right, which is
we've got this.
Decisions and policy have an effect, but not a direct effect. Mortgage experts believe that rates will stay fairly flat the rest of the year. Sure, there'll be.
Okay, so what he's basically saying, dovetails very well with what you've read here on Jay's Corner, right? Which is that R has been so volatile. It's just been so incredibly volatile. And on top of that, even bigger than that, is what I would say is that, because that's just the way that the world works, is that the bigger markets have been very volatile. We've had very volatile 10-year note. We've had volatile currency market. And these are not well thought through, right? They're not well recognized. People are focused in on their country, et cetera, et cetera. And I'm not going to call this, a purely an American thing, right? But you can see here that all of a sudden the dollar stopped being the safe haven. You can see it here, like a straight line to dollar. So this is euros for every how many euro would be able to be exchanged for $1, right? We've had 120s, and you can see back over here, we've been in the 120s, and you can see how precipitous this is. This is a 10% decline in the euro, and fast, right? Because really, you're talking about over in here, and you've seen also then as a result of that, this also dovetails very well with my Sacre Bleu entry on Jay's Corner, which is, we've seen the bigger markets not really cooperating with any of what were straight up markets for Apple and, Google. We had not seen that in the bigger markets, and left the world in a precarious spot at the same time that the Fed owns a third of all U.S. mortgages. So that kind of was your explanation. The rest of the world simply wasn't confirming it, or maybe it was confirming it in the sense that they just said, okay, let's just exchange all of our euro for dollars because the Fed keeps buying everything. That is an alternative, certainly one. At any rate, back to the point, which is from down here, 1.04 up to 1.07. These are not small. And because if you said 2% and then you said 2% in the equity market, well, now there's your 80 S&P 500 points. Let's take a look here. So basically what I would have said, before we get to this spot, which we will get to, very quickly, is the fact that, yeah, because of stability down here, we could return to the talk on whether or not this seas are accurate, whether or not, the world later is going to be a better place. I want to show you this. Let's just see if I can get us here. And by the way, that doesn't mean that we're not going to have ongoing debates. We are going to have ongoing debates. Because what you saw here, I've left you the information there, is the reality. The entire way. Nope. Which is, there's a video, worst bond market start ever.
But Bonawyn, do you feel better?
On this edition of You Must Be Kidding Me, we've got this.
Her decisions and policy have an effect, but not rates will stay fairly flat the rest of the year.
Okay.
It can literally...
We'll switch away from that. But basically what I'm saying is that you're still going to have tremendous questions about the numerator, which are all over the map. And this is the issue, is that they're so far over the map that, let's just take a look at whether or not, no, this is not a good. No, I don't think we're going to be able to do this. Yes, we are. Let's just go to monitor. Take a look at this. This is the day after NVIDIA, which basically runs most of the graphics cards in all of computers across the board, as well as data centers. So, the kids that are playing games online and things like that all run here off NVIDIA. The next morning, as a result of the earnings report, all of these different people dealing with the numerator all started to opine. Now, look at the range here. All right, so let's see. It was 375 down to 300. It was down to, so now we've got a different target price of 190, another target price of 182, another target price of 315. This is what? From $130 divided by 180, basically a 75% difference in opinion. That should give you an idea on how, it's pretty funny to me that, we have got this concentration on the numerator. Because these target prices don't tell you what the reference is on the R at that time. It's pretty odd. It's pretty odd, finding target price projections for me that somebody tells you, well, I think the fair price is 300 or 210, 300, that swing that wildly, because they're not even telling you, okay, where's the S&P 500? Where's the rest of the market trading on the equity risk premium? We've not talked about the market multiple in depth here. I will get to it, not today. But nevertheless, what you've had is some talk about now can be at least more stable and focused on the numerator. It allowed the path for higher. That's it. There's some other technical things. There's one other technical thing, and that people don't. They're called technical. When I call them technical, they can be technical for different reasons. One is for looking at these pretty pictures, right? Which is like this. Well, let's make sure that we do this correctly. Not display capture, but not window capture for sure. Nope. Not this guy. But let's just get to the display capture, to the window capture. There you are. So let's just take a look at this guy, right? For example, this is what we're normally focused on, as you know very well. We are looking at these lines, which some people believe are random, but have played out, by the way. Like I said, it doesn't matter whether you think that they're random or not. If the people with the big amounts that are affecting the markets are using the pictures, then you've got no choice, right? And you know this from practical experience. Ugh, I'm terrible. I'm back to loser here at video production. Sorry about that. So right here you can see it that, you know, you've had the 10-year, you've had the dollar, and let's just go here. S&P 500 this is the only one that I look at, to be candid with you. Not only, but you can remember, I'm trying to look here. I don't have my Winnie the Pooh mug. Followers here will find it almost no coincidence. Almost no coincidence. We've returned right back to these congestion areas. Right? The buyers and the sellers are trying to come to some agreement. They're trying to come to some agreement about how much my Winnie the Pooh coffee mug is worth. And, you know, for newcomers, I was trying to make the analogy to, it is not about finding about the agreement of price. Right? The market is it's not there to make you look smart. It's not there to say, hey, my guy thinks that Nvidia is worth 320. It isn't. The market is a price clearing mechanism to get agreement on what my market value of my smart water is. Didn't make me any smarter. Anyway, but you can see here, as I said, that in particular scenarios, when we have this, we will get some exploration here of these congestion zones. So while this seems extreme and quite violent and true, something 9% off the low here. You can see it here. Let's just take a look at how low this is. The low is 38.10. It's now 41.69. What is that? I'll just do the math here with my very sophisticated calculator. If I could use my phone. 41.69. 4169 divided by 38.10. The low on this day, just days ago, 38.10. 9.4% higher. 9.4% higher from low to high. Pretty remarkable stuff. Why? Instability of the denominator. The big numbers told you that this was set up to be violent. And so as a result, we're going to have to deal with wider error, wider moves until this settles down. From there, we can hit the side. Right? Once the world can get used to whether or not where R is on a more stable level, then we can then look back at C, and then we're going to get to the equity risk premium, which is an entirely huge thing by itself. Let's not go here. Let's go here. Yes. So not surprisingly, back to best of class. which is you could see that the equity market moved 2.7%, of which diversified funds, not just, randomly selected, right? But diversified funds basically told you what? They're not sitting there 100% in stocks. No way. Right? Otherwise, this number would have been 2.67, 2.7. Right? Because the equity market moved 2.75. This moved 1.67. By the way, and again, back to in isolation, you can see year to date still minus 11.56, right? This is sequence risk, right? It's not like these guys sitting here are buying the bottom either. They're not. And before somebody thinks that their way of constructing the portfolios is based off a singular method, that method has to be singular. How do you know? Even on a violence of the last 2 days, look how close they are year to date. 11.56 at BlackRock. Vanguard, same target retirement date, 11.61 minus. 0.05% difference. 0.05% difference. On $1,000, that's what is that? 1% is $10. That's 1%. Right? Of 1,000 is 10. That means they're different by 50 cents on $1,000. To give you an idea, in other words, there's no way that they're guessing, right? They've got a particular setup which is very complicated. It's very complicated to everyday people. For you Uber math, if you're a math jockey, it's a joke. Okay, so not everyone understands what linear algebra even is. Okay, but you can see what your expectation reasonably might have been. And this is the real reason, that to try to give people an idea on how difficult it has been, how choppy it has been when something breaks, when people are thinking that it's going to keep going up, when people have misunderstood the denominator. Right? That what happens is rational. This is now reasonable. People thought it wasn't that sensitive. Well, bonds don't matter because, my NVIDIA is going to keep going from, the all-time high. It's down by 40% from the high. And to give you an idea, if you're long the NASDAQ and the high flyers, you are down multiples of this. NASDAQ, even after this, is down something, 25% from the high? Stunning. That's your explanation on financial markets, to be candid with you. I'm not going to get too much further into the weeds here. I did want to give you some idea about kind of, where we've been. The fact that these congestion zones did end up working out. If I back up here, you can see how far we've traveled down here. And again, the world doesn't want too much lower up here. That all said, I'm not, David Downer here. I'm not making a prediction of any sort here. Of no sort here. It's just that when this is this unstable, the debate over NPV, which is the price of financial assets, whatever financial asset, including your household net worth, will move around. Now I'll get to here. I want to show you these. Let's just see if I can get to them correctly. Yes, I will be able to. I'm sure of it. Higher interest rates sounds like it's been harmful. But the reality is that to some people it has been there is a silver lining. And the silver lining is to the savers. There's a reason that I reposted these videos. Right. Is that the advisory stock brokerage community doesn't want you to go to annuities inherently. That's their inherent nature, right? That is not to, and they want to say, okay, well, annuities have these negative things. This particular video now, right, there's a reason that I reformatted the thumbnail. Because now the function of the annuity shows up. And in addition to that, the higher moving interest rates is going to increase the rate of crediting inside the annuity. It will. It invariably will. I've already seen it. Okay, so I get in my inbox, I get tons of emails from all the sellers of, buy my, sell my fund, sell this, sell that. By fund, I mean, sell my annuity, sell my life insurance policy to do this, that, or the other. Okay. Inside the annuities, inside this video, I give you, without naming a particular policy or company, about how the guts inside work. And still number one is, your age and your gender. Okay, that is always first, even bigger than markets. In addition to that, now though, the inputs inside the markets has actually helped annuities a lot. It has raised the amount that you can be credited inside the annuity. Okay. And as a result, it has changed the payout structure of what annuities can provide in the future. So without going and reviewing the annuity video, I think the video itself is is an hour, and I think I've cut it down because, YouTube likes 10-minute videos, which is nuts. But anyway, what you have here is an explanation of what's inside. We need time for money to be deposited in to an annuity in order to get the optimal value. And I understand, optimal is an air quotes term. But it's there now. It's absolutely there. And in addition to that, that also means it's here. Which is that this one as well. So again, Jay's Corner is to try to take away the jargon, right? But focus on the function and explain correctly the function of what that money is doing and why it's doing it. Because like I said, the noise from the brokerage community is going to tell you this is bad, that's wasting money, this, they've got too many fees, etc., etc. Well, the reality is that, most of the brokerage community is going to be, notably lower than the minus 11.5% that I pointed out that Robo would have replicated. That's a fact. But now what has ended up happening, in addition to that, some of those monies here now and the higher interest rates will feed into the life insurance policy. So again, I encourage you to see these videos because they are more in depth on how they fit. And on last week's Jay's Corner on the live stream, what I did is I actually, now you can see the function of these different things. That is not, what Joe Broker wants you to do. It's inherently against the way the brokerage community works. That's just the way they're tilted. So as a result of all of that, what they've basically done is created a situation where they're diverting money away and glossing over the fact that, oh yeah, by the way, stock markets and financial markets do not go in a straight line higher. And in glossing over that term, and how did that glossing over occurred? Why? Because the world, including the stock brokerage community, doesn't pay enough attention to the bigger force here, which is the denominator. And I'm not saying everybody, right? I'm just saying in general terms. Everyone's like, my target price is $315 a share for NVIDIA. No one's debating whether or not NVIDIA is going to go broke. I'm sitting here under protest broadcasting on YouTube, for goodness sake. Okay, so I just wanted the segue here is that while the higher interest rates have created turmoil here, that has actually created value. It has actually created value in these other locations, which are largely neglected by the news of what's going on in these worlds, which do play a very important function for the persons with the resources, for the persons where this fits their financial plan. That's why, the comprehensive financial plan is about fit, so that we can get the function to what the person wants to actually accomplish, what their worries are not. Obviously, you can understand why we start with health insurance. And we'll go there now. I'm not going to speak for too much longer. But we'll talk about Medicare now as well as the ACA. There are some headlines that do need some attention. Let's just go here. Under health insurance, I've been under, as many people would have known, I have been, received a fair amount of, attention. I mean, quote, in air quotes, attention on the fact that I've been saying that, people should not overlook the huge financial impact of the APTC, which is the Advanced Premium Tax Credit. It is the healthcare subsidy used to lower your health insurance premium as well as lower your out-of-pocket maximum or deductibles in certain instances. But this is a financial planning, a tax matter, ultimately. The issue is that, as a result of COVID, for those persons who did not know, the amount of the subsidies has improved dramatically in response to COVID. Dramatically. That is set to expire at the end of this year, 2022. That the American Rescue Plan, as you can see here on this headline, right, that it is to end at the end of 22 unless the Build Back Better Act, which is the president's existing provision to permanently keep them in place. So without getting into politics, we would know that the approval ratings of the existing president are not great. And whether or not he's been able to push through this portion of his agenda still is yet to be seen. But I wanted to alert this to people because the time to be thinking about this in its absence is now. Because it will change the way that we withdraw from IRA, 401k, for example, if you are pre-Medicare and anywhere considering retirement or need the extra money. For example, let's say you're gonna retire when you're 64 and a half, and it's January of 2023, but you're currently working. Well, no one said you couldn't withdraw from certain locations to get the cash today, because then you're just going to be paying the income tax on that amount, or maybe you're going to be liquidating losses, even better, right? So now you can see it's going to become there are going to be opportunities as well as challenges, and then now the time is the time to consider it, because you need to understand that these subsidies could end in 2023. I'll be spending a lot of the second part of the year doing this. I'm very sure of that. Right? Because most of the time, the heavy lifting by me is not helping somebody on their Medicare enrollment, but it's really on getting the fit on these extra parts. And the financial difference to households is thousands of dollars. It's not whether or not I'm going to, help you with Medigap Carrier 1 versus Medigap Carrier 3, where they differ by $30 a year. No, there's not a $30 a year premium difference. This is a 4-digit, and where the first digit is not 1 difference from tweaks that can and will be identified one way or the other. And by paying less, that's just, turning Rubik's Cube just from a different angle. The second one is here, which is sitting here up on, it's on Fierce Healthcare, but it's a re-report of KFF, which is Kaiser Family Foundation, which is one of the two places I probably tell people that I go to a lot. And that is that the public health emergency looks to be ending. And I don't know when this is going to be. It has been extended. It has been extended. But currently what happened as a result is that people were extended on Medicaid that their financial resources haven't been checked. The checks have, and by checks I'm not talking about the monetary check, but the examination of your household finances for Medicaid eligibility has basically been suspended as a result of COVID. That looks to be expiring this year. And so we need to be careful here, because if you have been part of Medicaid, or if someone very importantly, has received Medicaid and as a result pays $0 for health insurance, but some people are so far below that they receive SSI, which is actually income from the government. I'm not talking about that. What I'm talking about is somebody, you have some income, but it's low. So as a result of COVID, you got full Medicaid, not APTC, which I just spoke about. Medicaid being, it costs you $0. And your eligibility is usually subject to checking by a caseworker in your state. That's been suspended for now. And what I'm saying is that the for now period looks to be ending. And you also need to know, but you don't need to be alarmed. So there's my first takeaway. Number one is you don't need to be alarmed, because there are going to be ways to access the Affordable Care Act. That is true. There will be a special enrollment period. There's a special enrollment period now, actually, for those right on the borderline. If you lose Medicaid, you'll definitely get a special enrollment period to allow you to enroll into an Affordable Care Act plan. Okay? That window is not going to last forever. You can stay tuned to Jay's Corner. And the reality is that there are ways to save hundreds of dollars there as well for those persons who lose Medicaid eligibility. They're beyond today. But this is out there. And you can see 14 million people. This is not a small number. Right? This is every state in the country, that those persons who have had Medicaid, those checks have stopped, meaning the examinations of your financial resources now is going to stop when the president announces an end to the public health emergency. And that's the specific thing that created this situation. Now, it's been extended, but it looks to be ending. And I'm just going to say that the CMS has been sending out memos and emails, etc., titled, "What to do when the public health emergency is declared over." In other words, everything is out there to tell me, beware, this is coming down the road. Last point, which is that, let's just see, where can I bring this up? What's the best place to bring this up? Okay. Nope, it's not going to be that easy. So what's happened here is okay. Back to Fierce Finance. This is fine. I have reported that there was some chance and that it would be re-examined. That Medicare premiums, Part B premiums, were under examination as a result of the fact that this specific medication, which is the medication which has been approved for Alzheimer's, right? That because of the price decline of it before and after the Part B premium was determined, that since the price is lower, that the CMS would go and look back at the premiums for 2022, which are currently $170.30. $170.30. But instead, what has happened is that the Medicare Part B premium will be lowered in 2023. So in other words, they're not going to be lowered this year. It looks to be lowered next year. We're going to have a higher Social Security benefit amount. I think that that's pretty clear. I don't see deflation to come down, to all of a sudden strike the nation to such a degree, right, that your Social Security check would be lower. That's an almost impossible thing. There is going to be inflation of healthcare costs as a result of all of other inflationary matters, shortage of nurses, for example, mitigated by the fact that the savings from this particular Alzheimer's medication and the resulting calculation will mean a lower Part B premium. In other words, the increase would be less than would otherwise be expected, and whether or not it will actually go down, that is yet to be seen. Okay, nice and short and sweet today, mainly because I realize it's a 3-day weekend. I hope everyone stays safe and has a great weekend. Be sure to follow, subscribe, sign up for the newsletter. I can't tell you enough. I'm here on YouTube largely to iron out these things so that I can make better videos later. And I wanted to check to see how this would go and things like that. You can see it's getting better, although you can still see that, my prep time and all that kind of good stuff, isn't great because I've got other work to do. But I'm doing my best and I'm happy to keep everyone up to date with what I find amongst the maze of noise that exists out there. Have a great weekend, everybody.